Good morning, it's Monday the 6th of September and welcome to Atlantic Capital Markets roundup of the coming week's economic highlights to keep an eye out for. As always, we'll give you a quick summary of the macro data points from around the world to expect over the week, and we'll then dig into more detail on some of the bigger stories straight afterwards. So, stay tuned. So, let's take a look at the economic numbers being issued this week. And starting today, we have EU construction PMI figures and the German factory orders. On Tuesday, we have China trade balance figures, Australia's Reserve Bank decision, Germany's industrial production figures, and also the German ZEW sentiment index and the Eurozone GDP third estimate. On Wednesday, we have that all-important interest rate decision from Canada's central bank. On Thursday, you can look out for the China inflation figures, ECB interest rate decision, and an important one that we'll be talking about in more depth in a moment, the US initial jobless claims, and the US EIA crude oil inventories. Friday, of course, a big one, the UK GDP figures, and again we'll be talking about those in more depth in a moment, the UK trade balance and UK industrial production figures, and the US producer price index figures. So, which companies can we expect to hear from this week with reports and trading updates? Well, on Monday, we'll hear from Dechra Pharmaceuticals. On Tuesday, Ted Baker and DS Smith, and we'll be talking more about these two in a moment. TP ICAP, McBride and Vistry. On Wednesday, we'll be getting results from both Dunelm and GameStop, and again, we'll be talking more about these two in a moment. Thursday brings us Capital and Regional, Computer Centre, Go Ahead Group, and the supermarket group Morrison, where there's a lot happening that we'll talk about as well in more depth shortly. So the Federal Reserve has been the dominant focus over the past 2 weeks. After Friday's dismal non-farm payroll numbers, the timing of the Fed's next move is less clear. This week's attention remains, of course, on a big week for the central banks, with interest rate decisions from the Reserve Bank of Australia, the Bank of Canada and the European Central Bank. Now, the RBA and the BOC have already started tapering bond purchases. Will this continue? The ECB is set to continue the debate on whether they should taper QE. So let's take a look at some of those key stories in detail. Progress in turnaround plans will be key when the fashion retailer Ted Baker releases a trading update on Tuesday. Now, Ted Baker's focus on formal wear meant it was hit harder than its peers across the pandemic. And this, combined with its high bricks and mortar store numbers, has meant that cost-cutting has been key for the firm's survival. Online sales still have plenty of room for improvement. Any changes in the online sales figures will of course be key. Also on Tuesday, we'll be hearing from DS Smith. Now, the pandemic boosted e-commerce, sending demand for cardboard boxes surging in the second half of the year, which has helped offset weakness in the industrial packaging business. DS Smith is expected to report a significant year-over-year rise in sales volumes amid favourable comparisons after the COVID weakness in the fiscal Q1 last year. DS Smith could well be approaching pre-pandemic demand levels. Management have flagged inflation as a potential issue. However, this is expected to have been passed on to the customer without too many issues so far. Whether this can continue going forward is questionable, and management could provide further clues as to how they intend to deal with persistently high inflation. The stock trades at an almost 3-year high. So on Wednesday, Dunelm is due to report after its share price tanked 15% over recent weeks. Now, the soft furnishings retailer has fallen out of favour amidst the reopening trade. Whilst Dunelm did well across the pandemic, investors have been drawn to more exciting recovery trades. Even upbeat trading updates have failed to lure back that interest. Now, management revised the full-year forecast to £158 million from £125 million, although costs could also increase due to supply chain disruptions. Whilst home improvements dominated during the lockdown COVID era, the reopening play is more focused on cyclical stocks and stocks which are expected to recover faster. This could be a tough crowd to please, even with strong results. So also on Wednesday, GameStop is due to report earnings after the close, and GameStop has been one of the hottest stocks this year. Although this has little to do with fundamentals and more to do with its popularity amongst the retail crowd in the short squeeze trend. Fundamentally, GameStop has been under pressure for some time amidst falling sales as online game stores eat up its market share. The bricks and mortar gaming store has taken steps to turn the business around, closing hundreds of stores. And this did help boost Q1 numbers by 25% to $1.28 billion and slash losses 0.45 cents of a share. Whilst progress has been made, there is still a long road to recovery as GameStop works hard to boost its online presence. The firm has given itself more time by selling 5 million shares in June, raising another $1.1 billion on top of the $551 million it raised back in April. Losses expected at 56 cents. On Thursday, Morrison's is due to release half-year results, which comes following the stock's promotion into the FTSE 100 and an ongoing bidding war between US private equity firms. Clayton, W. Rice CD&R is so far winning that bidding war with its latest bid of $2.85 a share, or $7 billion in total. However, there is still time for rival bidder Fortress to come back with a decent counteroffer. Now, Morrison saw Q1 sales rise by 5.3%, with online sales surging 113%. Fuel sales also returned to pre-pandemic levels. Q2 numbers could see a boost from the Euro 2020 football tournament, of course. However, as the UK economy reopened, there's also a good chance that sales growth slowed. And according to Kantar, in 12 weeks to 8th of August, like-for-like sales were down 6.2% on 2020. But are still higher than pre-pandemic levels. Morrison trades around its all-time high. So the other big story for Thursday is, of course, the ECB rate decision. Well, the July ECB meeting was uneventful, as expected. But the ECB recently announced a change to the inflation mandate, meaning that they have the flexibility to tolerate a slightly higher rate of inflation than previously. So, therefore, even with inflation on the rise, the attention is likely to be on the Pandemic Emergency Purchase Programme, or the PEP programme, and when the ECB might look to start reining in those bond purchases. Well, the PEP programme is due to run until March 2022. So far, there is little consensus over extending beyond this date. In fact, the recent jump in inflation to 3% could well focus the debate further this month, as more hawkish ECB members start to become more vocal. However, with German elections due next month, the ECB could well look to hold off from any move. So with all this in mind, of course, keep an eye out on the euro. On Friday, UK GDP figures are released, and the June month-on-month GDP prompted at 1%, up from 0.6% in May. Now, the remaining COVID restrictions were removed in July, so it would be fair to assume that we could expect another positive month. That said, it's worth keeping in mind that pingdom and rising COVID cases in July could have affected GDP, as huge numbers of people were told by the NHS app to self-isolate. Expectations are for July GDP to increase by 0.8% month-on-month, with the 3-month figure easing back to 3.8% from 4.8%. So with this in mind, keep an eye on the pound and, of course, the FTSE. So also in the US on Friday, the US PPI figures are released, and inflation continues to be a hot topic across the financial markets. PPI inflation remains high, hitting 7.8% in July, with few signs of this calming amidst ongoing supply chain disruptions. Rising freight rates, higher raw material input costs, and worker shortages across the supply chain are all still contributing to those rising prices. Now, at some point, these price pressures will start to trickle down to company margins and into consumer prices. Expectations are for PPI in August to rise to 8.3%, with core prices rising to 6.6% from 6.2%. The forecast rise in PPI suggests that elevated inflation could be more persistent than originally expected, and we could see CPI move higher still in the coming months. So finally, let's take a look at the dividends for this week. In the FTSE 100, there is the Croda International dividend, the Avast, Polymetal International, CRH and Melrose. In the FTSE 250, Oxford Instruments, XP Power, Greggs, Derwent London, GAMESTOP Group and Hochschild Mining. So that's what to look out for this coming week, and we of course hope it's a good one for you. And of course, don't forget to look out for our rundown every Friday morning, where we take a look at what's happened in the markets over the week with our own thoughts and analysis. So until Friday, from all of us at Atlantic Capital Markets, have a great week.